All right, we have another fantastic panel for you guys, and the name of the panel is Investor Insights, Equity versus Tokens. And we're joined by a super packed, star-filled, and impressive panel. I'll go through a quick call out of everyone's names and their firms, and then I'll give you an opportunity to do a quick intro to yourself. So try to keep it to a minute or two. So at the far left, we have David Lee, who is the managing partner of Refactor Capital, also joined by Michael Arrington, who is the partner of XRP Capital.
It's Arrington XRP Capital.
Arrington XRP Capital. We also have Dovey, managing director of Danhua Capital, and Roland Yao, managing partner of CoCoon Ignite. And I'm Jonathan Ha, your moderator from Red Pulse. So we'll start from that end. David, you want to just do a quick intro to yourself as to what your firm does and how you got into this space?
So first of all, thank you for having us here, Hashed and the other supporters. My name is David Lee, managing partner of Refactor Capital, venture capital firm investing primarily in seed stage companies. Before Refactor, I was managing partner of a firm called SV Angel. There I led some seed investments around 2012, 2013 in some Bitcoin blockchain companies, Coinbase, LedgerX, Blockstack, Chain.com. Took some time off from crypto, and so that shows you my timing. Sort of got interested again just in terms of seeing obviously the activity, the interest, and now spending more time just learning and investing in companies here in Asia and also in the US.
My name is Mike Arrington. I'm with Arrington XRP Capital. So David, I'm going to talk a little bit about David. He is an old friend. I've known David since I founded TechCrunch in 2005. No, I'm not going to say any bad stuff. David is known as the most helpful investor you can get. So Y Combinator, and I'm sure you guys, at least most of you are familiar with Y Combinator, did a poll of their companies, and they asked who the most helpful investor was. And it's like every single one of them literally said him. And he was a competitor of mine, so I wish more of them had said me. And I personally know a company that we've just invested in, both of us. He only put a very small amount of money in. He only put $25,000 in. But he made some introductions, and he spent a lot of time with them that it resulted in a business introduction that probably tripled the value of the company. And so I'm a big fan of his. And he also is a big investor in Pinterest, got me in Pinterest, Airbnb, got me in Airbnb. So he's a good guy. And if you want to raise money, go to me, but also him. So I founded TechCrunch in 2005.
Speechless.
I sold it in 2010. They fired me right after that, and then I raised 3 venture funds called Crunch Fund, and we did a little bit of crypto, but not a lot. And then last year I decided I really wanted to get into crypto. The first company I invested in was Proppy, which is here now. And we made a lot of money on Proppy, and I thought, well, this is pretty easy, even compared to venture capital. So I went out and raised a crypto fund, $100 million fund at the end of the year, and I've been investing that with my partners since then. Yeah.
Cool. So hey guys, my name is Dovey with Danhua Capital. And David and Michael are really good friends, and Michael made a lot of money from Proppy, but the most valuable asset from Proppy is actually the founder from Proppy, Natalia. Right now is Michael's lifelong partner. So that's a really sweet story. Our fund has been doing crypto investment since 2014, and we have been pretty active in the space, cover Asia, US, and all the top deals out there. And especially we have pretty good access in all these academic and really hardcore cryptographers. So that's where our edge is. We have been investing in Divinity since 4 years ago, Base Attention Token in 2016. We are also LP in Pantera Capital, Polychain, and first round of Kyber Network, and fast forward a lot of stuff. And so how I got into crypto, so like the story is actually kind of interesting. So my mom, just like any Asian mom, like she wanted me to buy a house in San Francisco. So when I already had one house in like just like South Bay in like Menlo Park, and so she wanted me to buy another house in San Francisco, like which I don't want to do it because a lot of hassle. And then like also like so there's like a capital control thing like back in China. So basically like each individual can only like move out like $50,000 like per year. And so I basically convinced my mom to just like put all the money to Bitcoin. Like that's in like late 2014. And so I basically telling her saying, okay, mom, so I will buy house whenever I see any good inventory, but you have to first move the money out. And my mom right now is pretty happy because of the money that like she had as a down payment for me, like for San Francisco house, and now probably can buy like a lot of house in San Francisco. So I think that's a really good like manifesto for how crypto can become like a world currency. And so that's my personal story.
Hi everyone, my name is Roland. I'm a partner at CoCoon Ventures. We are a seed stage fund investing globally. And the majority of our LPs are family offices and family managed and owned businesses. And so a lot of perhaps what we discussed today will be coming from that perspective also. We haven't touched cryptos or tokens just yet, but we're certainly looking at that simply because of the LP demand that we have, which we'll talk about a bit more later.
Great. And very quick one for myself. Prior to launching Red Pulse, I was in consulting for about 15 years and then started a small research firm, realized nobody wants to pay for research anymore, and then got into crypto by doing an ICO late last year. We're the first application and ICO on the Neo blockchain, and then are soon to launch. So that's something that I'm very excited about. So with that, we'll jump straight into the questions. So the first one, a bit more of just setting the scene. What are the pros and cons of issuing tokens versus equity from the perspective of the company or the project team?
From the perspective of who?
Of the project team.
So project team. I can go first. I think like first of all, token is not like a silver bullet. And so not all the application or like business logic can be decentralized. I think like many of the projects right now, so they're using token as like a way to cash out, and so that's not a really right way to do it. And so when it comes to like token, like definitely, so there's like liquidity like premium, and so you have like shorter cycle of like liquidity, stuff like that. But it can also be a huge distraction. Basically, you are running as like a mini public company, right? And public company has a department as like investor relationship, and so they have like managed expectation of like all the investors. Like so basically when you're like a company doing token sale, and you have to manage like expectation of like investor from the globe. And so that's a lot of work. I think like the good thing for like token is, if you can design like really good like token mechanics and really good like game theoretical design, and so you can basically like bootstrap your own like user base. So you can like bootstrap like the network effect. So I think there's like both pros and cons for like project team, and so they have to really evaluate first of all whether something that they are like doing right now should be decentralized, and then like second is like what are the token is used for, and what is like the real utility of the token, and then is it just like vaporware or just payment token or like access token, and so those are tokens that cannot be like long-term sustainable, and then like the last thing is, and when are you considering about like liquidity, and then so what are you going to manage like those investor expectation? So there will be my comments on that.
Oh, this is a good company that just messaged you.
We already invested.
I'd like an introduction to them. Yeah.
Anybody else want to jump in?
Well, so I think that when you sell tokens, you're selling something for nothing, right? I mean, you're making up something when you're not with no underlying financial asset, and unless you're talking about a security token. So it's fan-fucking-tastic, right? I mean, you don't have to give up equity in your company, and so if you can do it by finding a way to do it right, like Dovey just said, of course do that.
For a very early stage startup, though, aren't you really also selling something, for nothing? The equity in the company is so early. Can you really say that has that much value?
Well, but when you eventually sell your company or go public, you get something for your stock, and if you don't have to give that stock to anyone else, then you get more of the stuff when you sell the stock, right? So I think I'm going to stick with my original statement. It's great, yeah.
Yeah.
And it also is much easier, and you don't have to deal with all the people in Silicon Valley who seems like their entire job is to stop you from getting money. You can go out to a lot of other people.
I think one obvious advantage and then also disadvantage for an investor is right now token has no governance. There's no clear governance, just a corporate governance in general. And you as entrepreneur, you can actually do whatever you want, to be honest. So there's enough freedom and flexibility. But if you want to keep out a high ethical standard, and so you want to do it well. But I think in general, the flexibility and then also freedom of capital control, so probably can give you a lot of opportunity to develop things just more agile and just faster, and then so you can iterate faster and basically when it comes to resource allocation as a company, and so you have you have more room.
Right.
And just echoing something that was spoken yesterday about just the nature of investors, it's not one size fits all, and there are many different kinds of investors. And I think from the project company point of view, you have to honestly consider the resources that you need to grow. We always talk about strategic investors, people that can anchor certain rounds to lead it and help you market it. That very much equity ties nicely into that, because as a traditional security, the incentives seem a bit more aligned, so you can draw that kind of resource sharing or strategic partnership with some of your investors. But certainly, if project companies are more about speed to market, building out the war chest, knowing all the corporate governance issues and risks involved, but you already have a separate way or a different way of thinking about how you're going to go to market, then a case could be made about you can go after a separate set of investors that are looking for fast liquidity windows, maybe pump and dump, but that will be a different set of investors from your more traditional equity investors.
I think that one fundamental advantage I can think about is equity represents future cash flow, and that's very homogeneous type of asset. But token itself can represent a lot of things, right? Access, voting rights, and membership, and then probably also future cash flow, and then probably share of profits. So I think the heterogeneous characteristic of token itself, so can actually help you to design a business model that can probably completely different than original business model. The original business model, when you're running a venture business, you want to build this a monopoly and try to maximize your operational income as much as possible. But when it comes to token as a vehicle, so there's many other things that you can bake into it. So I think that's a fundamental advantage of having token, but you have to do it right though.
So not much to add, because I think all of the other panelists sort of I'd just be echoing their statements. I think the two things though that I'd highlight is you think about, at least back in the day is 2006, when social was a big thing, the social web, and you saw a lot of startups and they said, okay, we need to get social, and it's sort of this layer that you slap on top of the product. And it turned out that was a bad approach, and you had to start it from day one, and you had to build it natively into your product. And that's what I think about with tokens. So it's something that, if it's something that's just slapped on to your product or your offering, that's probably less compelling as opposed to whether or not it actually makes the whole product better. And so, or you can also think of business models. You think about what Google did with their advertising, which that was kind of native to their product. So there's that. And then also, I think fundamentally it's just, fundraising is all situational. There's all this advice out there, you should do this, you should do that. It all depends on the founding team. And some founding teams, they probably might benefit from having some advice or an investor who can help. And some founding teams, they just need the money. And they just need the money because the investors are going to do more harm than good. And so I think what tokens represent is just this flattening of basically, not a flattening, but just an acceleration of this trend towards crowdfunding and or just underwriting any project. And that for founders, you just have more choices than ever.
Great points. And I think one thing is becoming quite clear. There does seem to be a lack of regulations and frameworks that somewhat polices or moderates the fundraising via these crowdsourcing channels, the ICO, the token sales. Do you feel that there's going to be something that comes on down the line that better regulates this environment? And what might that look like?
What's the question?
Regulation.
Regulations.
Regulations. Basically.
Regulation is bad.
It's bad,
Next
outright.
question. Yeah.
Okay.
Look, you guys are crazy over here. Present company excluded. But like, it's like there's clearly like a lot of bad stuff happening that should be regulated. But on the other hand, it's allowed this explosion of creativity that may not have happened otherwise. And you can look at the US where we're regulated to the point of paralysis at this point, where 80% of our deals are in Asia and Europe now. Because the Americans don't know what to do with themselves because they're so scared of the SEC. And that's more like threatened regulation. So I'm a libertarian. I kind of feel like let people do what they can, try to stop the really bad stuff, but let people experiment.
I think like why we need like regulation. So I hold slightly different opinion than Michael. So I'm not like pro regulation, but I think like regulation is definitely necessary because like regulation has to protect like retail investor from fraud. So that is the fundamental purpose of like having regulation. So like down the road,
Why?
what?
Why?
Yeah, of course.
No,
so,
why?
So like
Why do investors have to be protective? Why don't we let IQ sort that out?
we are not living in like a society that's a full social Darwinism. And then so if we are in that jungle rules type of like environment and a lot of things gonna be 100% like obsolete. But we as a human being, as a Homo sapien, as one species, we want to preserve our diversity.
Yeah, that's a straw man argument to say that like we're gonna be in as you said, social Darwinism if we don't do what you want. Right? So we come from different cultural backgrounds. I come from the cultural background of like do whatever you want as long as you're not hurting other people. And you come from a different world. But I think that like, why not let people do what they want as long as they're not hurting other people? If the answer is you need to protect stupid investors from their own stupidity, let them go broke.
No, but the thing is that a lot of retail investors, they don't have enough information.
Good, then they'll go out of business.
So like to make judgment, right?
Yeah.
And then so if you open up that channel to like retail investor, and so they can be getting just a rip-off.
But retail
and so,
investors can give you their money to invest instead.
That's right.
Capitalism works. Like, what's the problem? Look at what it's done to bring people out of poverty in China. Hundreds of millions of people aren't poor now in China.
The problem right now is like the whole thing becoming more and more like just like distributed, right? And so we are moving towards like crowdfunding. Like what's that? So what is like crowdfunding?
We're moving away from crowdfunding. No one crowdfunds anymore. That was last year, right?
No, we are crowdfunding.
Who?
So I think absolutely like a lot of like this so
that's why it's so great for us. We have all the deal flow now because all the crowdfunding has died because of regulation. So the average person that doesn't have a $100 million hedge fund can no longer get into these deals, which is why I'm making all this money, which is why you're making so much money. It's great for us. It's terrible for everyone else.
I think it is, to some extent, it's actually protecting them as well, right?
It's protecting them from making as much money as we are.
It is protecting them from ripping off as well.
Anyway, there's a little bit of drama. That's all I got. Yeah.
Michael is really good at this. So I've been on panel with him, and we always fight.
Makes for a more exciting panel. It's great. Any other thoughts, guys, on the topic, or?
Well, I mean, I think the slight nuance here is that not all regulation is bad, but bad regulation is terrible. And the right way of thinking about it is could be helpful, with the purpose of protecting the minorities. Whether through the type of information people receive or just, warning signs and disclaimers. So, I mean, if it's for more leveling out the market, and there's still opportunities there. I mean, right now it's a bit asymmetrical. Some of us are, doing extremely well versus others, but that cannot be the most stable, sustainable way forward. So, it's just fixing the extremities on both ends, and the right regulations are trying to just make things a bit more balanced. So whereas too much regulation or stupid regulation where you shut things down because of fear, that's terrible for the market, and I believe in that. But completely free market where, it's a Wild West, I don't think that's sustainable in the longer run. If you're in the Wild West now and you're able to catch opportunities, great for you, but that party's gonna end at some point. And so I think globally, when we look at all the various jurisdictions trying to regulate this. I mean, the inconsistent regulation shows a bit of cultural difference. It shows different market approach towards investment, but it's still necessary to some extent. And I think the winners in this space will be the people who are well advised, speaking to the right, technologists, the people doing great projects, as well as the investment community and the professionals. And when they come together to come with the right regulations, the winner will come out from there. So you can't completely clamp down, but you also cannot just have a free for all.
So like the problem with the current regulators is, I think they're super lazy, and so like the evolution of the regulation cannot keep up with the space. Cannot keep up with the pace of like what the current technology is actually evolving. So like I said, like previously, like equity only represent like future cash flow. And like right now, like token represent like just a multiple different like financial vehicles, right? And so it's not just for regulation, like taxation, accounting, like all this has to actually like evolve like with like what we currently have. So that is like the problem is that RegTech is just not keeping up with like what's happening now. And so I think like if like they are more willing to collaborate and like with all of us and like with like people on the ground, and so I think there will be more symbiosis between entrepreneur, investor, like exchanges and regulators.
But here's an interesting thought for that though, because certainly jurisdictionally, there's a question there, because at what point does a digital asset move from one jurisdiction to the next? And if you apply a very traditional framework and thinking about that, which jurisdiction, which body will have the right to regulate that certain digital asset? And so if we're talking about, okay, we agree that there is some type of regulatory framework that's needed, but we're also dealing with an asset that by nature is meant to be everywhere. Are we then suggesting a global regulation framework? Are we suggesting some type of collaboration? And if we do that, which is fine, then where's the competitive edge? From the traditional way of thinking about, oh, I might do a listing or a deal in New York versus Hong Kong versus London. Do we have to rethink those competitive edges? And I think it's an interesting question.
Yeah.
And certainly collaboration, when we think about that, that's fine, but will it lead to this rethinking of the way capital or security markets function?
Sure. Yeah, I think great points, and I can see Mike's brow furrowing as you just mentioned global framework for regulations. But let's bring it back to the topic, which is equity versus tokens. And so similar question as before, except from the investor standpoint. So as an investor, equity versus tokens.
Go ahead. No, you go ahead. You don't talk much, but when you say stuff, it sounds smart. So you're Korean, by the way.
Again, I'm speechless, and I don't speak a lick of Korean. I know you wanted to say it, so it's out there.
You're Korean, you're in Korea, and you can't even say hello in Korean.
Equity versus tokens. I mean, it depends. The answer is it depends. As a fund, as a VC fund, tokens are hard, and we can talk about why it's hard. The basic idea is our job is to invest in VCs, traditional VCs. I think everybody in the room understands this. You invest in something, you wait usually, if it's good, 7 to 10 years, and it becomes liquid. And then if you're managing money, you have to decide what you do with it once it becomes liquid. Some people sell immediately, some people hold and think they're public market investors. Sometimes there's a reason to hold because maybe you're on the board of directors. Tokens are much different, obviously, where it's just flipped, right? And so my issue is that if something goes live in 2 years or a year, it's now liquid, right? Technically, I should just give it to our investors, some who are pretty sophisticated crypto investors, some who aren't. And do I become a quasi-trader? What's my role there? And so I think that's what all investors are struggling with. So to remove that, they would prefer equity. But the reality is the founders want tokens. And then a good investor is just they're going to follow what the founders want to a degree. And so that's sort of, again, it's all situational, depends on the founder, depends on the dynamics of the opportunity, i.e. the competition. So I don't think there's any right answer.
You want to go ahead? Okay.
I'll just disagree with whatever you say.
Yeah, let's do it.
All right. You're wrong.
I think first of all, when it comes to token, so token is, so it's like a different animal, but it's also something in common with the equity that for investor is one kind of asset. But token as an asset requires investor with both insight and skill set from both capital market and primary primary market. I think that's pretty hard for many investors out there. So for us, I think first of all we want to see whether the token itself makes sense. Whether the token has good design, protocol stuff, and economics and stuff like that. So that's something that we want to make sure first. And then afterwards, and so there's a lot of this logistic issue that David has mentioned, right? So trading issue, liquidity issue, and distribution issue. I think we don't have good solution yet as well. But we have to follow all the smart entrepreneur, what they're doing. If entrepreneur, if they are, so if they prefer token versus equity, and so they have pretty decent model, and we have to play with that. So that's my thought.
Because one thing I'll add is that, at least for companies, in the long run, it doesn't matter. In the long run, terms don't matter. In the long run, if the team builds something exceptionally valuable, and the terms just don't matter, whether you own tokens or equity. But the long run is 5-10 years, at least in our world. And so, but I think if you have a different time horizon, even in terms of how long is your fund, it does matter. It really does matter. So it depends. An investor is going to give you a different answer depending on how their fund is structured.
And then also the difficult part for investors are so first how to value token, right? Valuation model is way different. So previously we have this PE ratio, PS ratio cannot hold on, so cannot hold up for token valuation because token underlying represent different types of asset, right? So or different rights. It's very hard to do valuation, and then also and the other thing is also hard to do corporate governance because legally speaking, entrepreneur does not need to give you any information right or any rights at all. Previously we have this preferred class versus common class, right? So we have liquidation preference and then all these things, and then we don't have all that in token. So that's something that can be hard for us.
We think about it from a portfolio approach and what the exposure that you want. So one of the, at least for our LP base, the most interesting case for tokens is the decoupling feature of tokens to the rest of the economy. And so in light of the world we live in today, where lots of things in the world of equity is connected, geopolitics and global events will affect just because you're doing a startup doesn't mean that you're disconnected from what's happening in the kind of larger, more mature market or the real economy. Token provides some will think that it provides some type of hedge or diversification in the overall portfolio. So we think of it as it needs to be both, and it's a matter of percentage allocation. Are you going to have majority of the fund take token or half? In our case, we think it has to be a minority that fits in some type of exotic class, but certainly need a bit of exposure to it.
Yeah, so just add on to that point, so we had done one analysis before. It's super interesting that just the entire crypto market, just all the tokens out there, so has no price correlation at all with S&P 500 and then bonds and commodity. So it can be a really good hedging, vehicle towards a traditional finance asset.
So I'll be brief, but I have a different take. I don't disagree with anything that anyone said except what Dovey said, but
Please.
I was a VC for a while, and now I'm entirely in crypto. And so for me, as an investor, it feels like venture capital was, I thought it was cutting edge, fast, and awesome, and that all the boring finance guys in New York wanted to really be me doing venture capital. But now I look back on VC as being slow and two-dimensional, because you'd invest money, and as David said, you'd wait some number of years. and find out what happens. We invested in Airbnb in 2010, right?
So, yeah, around
And I mean, we're still like, we've definitely made a lot of money, but I don't.
Paper money though, right?
But there's, well, it's going to be real money, but it just isn't here yet. I mean,
so now it's paper money.
Dovey, just let me talk. Your female privilege is overbearing right now. Yes, yeah. Anyway, it's boring. This stuff's cool because like Nexo is a company that we invested in that's one of the few, if only European companies, that you can give them Bitcoin and they give you loans back. And you invest in something like that. We've invested in some stuff where you're lending stuff in VC and you wait years. With Nexo, we invested and we waited a month, and they're doing loans, and we have tokens that went up a few X. We sold a few, and like it's money back to us, and it's just so fast and awesome and wonderful. And then the losers also point themselves out very quickly as well, and you don't have to wait around. Yeah. And so it's just much more exciting for me, and I really, really enjoy it. And also because most of my former competitors haven't gotten it yet, I feel like we're way out in front. Like most of the VCs in Silicon Valley are still like going like what's going on, and now I have a year head start on them at least. So it's just a lot more fun for me. Yeah.
Have there been cases where you've invested both on the equity side and the token side?
He does, I think. Yes.
On the same project?
Yeah,
sometimes.
on the same project, yeah.
Our LPs don't like equity. Our LPs, we're a hedge fund, so we're supposed to stay liquid, and if we do equity, it has to go in a side fund, and it's complicated and annoying. But we do it sometimes, but we might do like $50 or $100 or $200,000 in equity, whereas we might do $3 million in tokens just because it's annoying and a lot of friction with us for equity. Yeah.
And like nowadays, we have seen more and more structure, just like corporate structure in the sense that
you do both. Like you do a ton of
yeah. So like we do both, and so like nowadays more and more structure is moving towards because if you have like two independent structure of token versus equity, and so there's like an intrinsic conflict of interest of your equity investor and like token investor, because many of these like token businesses actually cannibalizing your existing equity business, right? So that's why I'm seeing more and more just like two-in-one. Basically, like the token issuer is actually like a fully owned like subsidiary of of the original like equity company. So like you as an equity ownership, you as an equity owner will have the indirect ownership towards token. So basically the token is 100% owned by the equity company. So we have seen more of that nowadays. So I think it will be like probably the line becoming more and more blurred.
Sure. Mm-hmm. And to touch on Mike's point earlier about having that 1 year head start, I think that's really interesting. In fact, there's a lot of corollaries you can take in that head start. But it's changing, right? I mean, you have the likes of AZ coming in, launching a pretty large fund, a few other well-established VC firms that are also going crypto, so to speak. How do you think that's going to impact the space?
So I've chatted with many like major, just mega-sized VC out there, and so like single fund over like $1 billion, and I think that most of them are right now wait and see. So one key reason is if you think about the most successful token investment, it can be 100x, that's different. But like the actual return, like the absolute like cash on cash return. Might be like 100 million or like a few hundred million at most, because the current liquidity of like this token thing is still small, like comparing with a traditional venture space. So many of these VCs, like one single return, it can be multi-billion. So I think because of this different order of magnitude, so that's why they're still wait and see. So like that's just one of my like key learning by talking with most of my Sand Hill friends out there. Yeah.
I love competition. I think apparently a social Darwinist, I say bring it on. There's a lot of bad VCs. Most VCs lose money. I look forward to them coming into this industry and losing money here too as well. But also just more money in the system is good for everybody, I think. And so I think it's fantastic. Yeah, the more the merrier.
So one problem, and I think like most of traditional venture capitalism, when they make token investment, so they're still looking for ownership concentration. So that is actually a huge problem for me, because token fundraise is by nature should be decentralized. many of these like VC firms, like they're still looking for 20% token ownership. So that's insane. And I think it would be really bad for the project.
Yeah, I mean, I think on the one hand, I agree with Mike in that, hey, I think being first in any industry is you're going to have a short-term advantage, but like any short-term advantage, that's going to be arbitraged away. You're going to have a lot of really good competition. I think part of it as well is that this is just fundamentally different from what technology investors are used to investing in. And a part of it is just the distributed nature as well, not just in the technology, but in the teams, where you have to get on a plane and you have to go to different parts. I mean, the whole point is that the initial condition isn't four dudes starting, creating the transistor, and then Silicon Valley creates. It's that the founding teams are everywhere throughout the world. And I think ingraining that in yourself early as an investor and doing that, I think is an advantage because that behavior change is hard.
Could you imagine S. the Angel coming to Korea and speaking at a conference? I mean, I never came to Asia when I was doing, now I'm all over the world.
Yeah, and so I mean, I think just that
fantastic,
mentality, and again, you're going to have competitors in any industry. Being first is always helpful. It's a short-term edge, but that edge is going to be arbitraged away. And so then it's like, okay, and so it's the job of everybody on the panel to just compound that edge, and so that you become sort of the team or the source that teams want to go to.
And some investor strategy could be as simple as wait for the second wave. In any industry, in any asset class, there's a strategy to say, well, there is still, no matter how much big money is coming in, it's still relative to the overall investment space, it's still relatively small. So some might want to sit on the sidelines, wait for big names, great talent, to make all the mistakes, to kind of create all the best practices, with or without regulations, whatever that may be. And then, the second wave of money will be maybe the institutions, maybe the more traditional folks coming in. So that could be a possible strategy also. So it's always a good thing to have that first wave come through. It's a serious wave with good money and good talent. And you can either choose to participate and be part of that best practice formation, or you're just a second wave follow-on.
And then the other thing is VC used to be super regional. And like Silicon Valley is considered as like the core of like innovation and like the source of like everything. I think like crypto, it might be the first sector that Silicon Valley or US has no unfair advantage and then probably disadvantage in accessing community, talent, capital. So like the globalization by nature makes me like super excited about this.
Yeah, me too.
I think that would be certainly a sort of utopian sort of end game for investors and for companies that are looking for investment. But isn't there something to be said for these brand names, these big reputational, well, good reputation brand names that are now attaching their name to a particular project? That might still have some degree of advantage, right, for the Silicon Valley side.
Yeah, there's a reason why when we invest in somebody, they put our logo up on their site and we put their logo up on our site. There's reasons for that. And it's a social signal that we've done due diligence and believe in them. And Danhua being up there is considered a really good mark. And that's why David talked about compounding that edge. You can't rest on your laurels. Last night at a dinner I was at, we were talking about some of the sort of the top tier investors that 6 months ago were like super awesome. And now it's like they're not really super awesome anymore, and they just kind of quietly fade away. And it's like, why? They made one or two missteps. They got arrogant. Who knows? So you do have to stay sharp. But once you're doing well, as long as you stay sharp and humble, I think you can do well.
Great points.
Yeah. So I think like definitely traditional, like just a big brand VC has this brand halo effect. But like if you look closer to the VC industry and like every wave, just like every technology wave, so they actually like make like a few names of the VC. Like S. the Angel is one of these like legendary firm in the Valley, has been around for 20, 30 years, and then so we have seen new like just like venture just like VC firm like coming up, and so like it's so like say for instance mobile internet and just on-demand economy and just all these things that like different wave will make different we'll actually like make different brand names. And I think like crypto is also like a wave right now that is really good opportunity for like the first movers.
And I think, yeah, one of the things that crypto does, it just removes middlemen. And that's, what's happening in media, especially, you look at media news, at least in the US, there's still the New York Times and CNN and Washington Post and Fox News, but the rest are you're always going to have 2 or 3 where people say, okay, those are the brand names. So I don't think some of the, the top tier Silicon Valley VC firms, they're not going anywhere. But the rest, like, you just have to imagine what happened to the media and news industry is going to happen to us.
Look at what happened
because
to Perkins Coie, though.
Because what's that?
When you say Kleiner Perkins, when you say they've actually fallen out of the top, they were the shit in the 90s, and now I know people that wouldn't raise money from them if they had to. So, I mean, there are
going to be missteps for sure, but I think having that institutional brand name is always going to be
helpful.
It's going to be helpful, but it's not going to have the same importance maybe that where you just needed to be a logo like 20 years ago. In the same way that being a newspaper, you just don't have the distribution advantage that you once had, and so you just have to expect that. And all of us on this stage, we're going to be, we're going to get even more niche, just like that's what's happening in media. The properties that have really flourished they serve an audience and they do that really, really well.
So a lot of talk about waves coming through the industry, and I think it's probably accelerating, actually. Crypto as an industry is one of the fastest moving, fastest evolving industries, and with the equity versus token discussion, we may very well come across a situation where these companies have both listed equity and tokens, right? And so how will that look like? How will the equity that's listed, people can actually buy shares in the equity as well as buy the tokens? Is there going to be any sort of correlation between the two?
Oh, so like what's the question? So
shares, listed shares, and tokens.
So
and
basically one
dynamic,
company has both share, so like has both equity and token?
That's a good question too. Not necessarily what I was asking, but I like that question, which is why you would want to list both shares and have equity and have tokens, I should say. But I think that's an eventuality. There are some companies that are already doing that are going to have listed shares and tokens. And when we get to that situation, what's that going to look like?
I don't know. I think.
What's a listed share? What does that mean?
It's
like
when a company has gone public. Yeah.
What public companies also have tokens?
So far, not yet.
Who?
Not yet.
Oh,
not yet.
Right. Like so far, not yet. But I can speak for that. Like kind of, we have one portfolio, so I can't name it, but so it has this token issuance done like last year, super successful, and now it's a top 100 token. And because the token is partially owned by the equity entity, and so they're also doing like traditional fundraise for like Series C, and so it makes like the following investor like kind of hard to to have this valuation model for the equity company, because if you calculate the net asset of the company, so token can be considered as an asset. But on the other hand, if you claim that you are issuing like utility token, so that is more like a airline mileage. Basically, user can redeem that token for some service or like goods, right? That can be considered as liability as well. So it makes it very tricky. So I'm not sure in the future how it looks like, but I think eventually, so we will have like a new kind of exchange. So like probably like doing both share, just like equity share and then like token listing as well. And then like most likely in the future, and I think like everything will actually gravitate like towards like token, because like token as a financial vehicle, so it can hold like multiple different asset type, right? So that might be the future.
Well, the at least for the immediate time being, I think the easiest reference point, which is already happening in traditional exchanges across the world, is looking at it from a dual class structure. So we're not talking about shares versus shares, each having their own rights, but it'll be shares versus tokens. But you can apply the similar framework to think about, when you talk about valuation, you do separate your different shares and the rights attached to them and what they do. And in this case, it's going to be, all the features of a token, whether it's a utility or some type of special security with certain economic rights versus something more traditional. And issuers or companies that are doing this, at least in the process of listing both, just needs to be very, very clear the rationale behind why there's a split, the utility or the economic value for each of them, and then let the market decide which one they want to buy into and how they want to trade, token or security or shares.
Oh, so I can give one really good example. Like one of my portfolio, Chia Network, so they're going to do the first IPO, just like token, like IPO with that token related, and then so how they're gonna do it is they will basically IPO just public offering their equity, and then the token, it will be the dividend towards all the equity owners. I think that can actually connect the bridge. So that's one of pretty novel model that I have seen recently.
We're out of time.
Great points, guys.
Thank
Indeed
you.
we are. So let's give a round of applause for all of our panelists today. Thanks for joining us.